So you spotted that $500,000 house on a hill. It's a fantastic house, you're in love, but you only have $50,000 down to get that house. You're going to need a bank or a lender or someone to borrow you the $450,000 left so you can get that house in your name and get those sweet keys and moving like a boss. And when you get to the bank or the lender, you sign a couple contracts, everyone's happy, they give you the money, you close, and now you're sitting on your deck, happy as ever. That $450,000 that you got as a loan and the contract that you signed all together with the strings attached, that's your mortgage, and that's exactly what we're here to discuss today. 5 things to help you get the best possible mortgage for your situation. Let's go. And in continuing the example, let's start to define the terms and the terminologies that surround a mortgage. So these are things that you need to understand properly before we get into the rest of the video. And we're just defining certain things like the principal. The principal is a fancy name that they call the $450,000 that you borrowed. That's only the money that you borrowed, $450K, simple and easy. Now, the bank is kind of doing you a favor by borrowing you that money, and they intend to make some money back from giving you such a huge favor, from doing you such a huge favor. Any money back that you pay, in addition to your principal, is called your interest. Now, I'm going to keep things simple at this stage. You can have 2 types of interest or more, but once again, we're keeping it simple. You can have a fixed interest rate or a variable interest rate. So as the name sounds, a fixed interest rate is fixed. You pay the same amount of money over a long period of time. And variable, sometimes the money you're paying is a lot, other times it's not. Other times it's just normal. I'm going to dive really deep into interest rates in a separate video so you can get a full picture of what we're talking about. But for now, let's stay on topic. Now, if you remember, I mentioned that you're going to be paying your interest and your principal over a long period of time. That long period of time, usually ranging from 5 years all the way to 30 years, is called your amortization period. It's a fancy term, but just know that the amortization period is the period of time that you're going to be using to pay back both your interest and your principal. Now, within this amortization period, this 30 years, for example, the bank is going to call your attention to something, and something that happens, something that everyone notices all the time. And that thing is that the world is changing, money loses value, and most importantly, the Bank of Canada will either increase or decrease interest rates. And I know you've been hearing these things all around, and I will dive deeper into them in the interest rate video. But for now, anytime the Bank of Canada increases an interest rate or decreases an interest rate, it affects the bank. And you know banks, they're always trying to cover their and make sure that they are always making the profit that they should. For example, every 5 years, they're going to call you back to the table and say, hey, you borrowed $450,000, you've paid off, for example, $100,000. Now you have $350,000 to go. Take a look at the economy. The Bank of Canada has either increased interest rates or decreased interest rates. Let's go with increased because that's what's happening now. And they're going to look at the contract that you signed and say, hey, we signed this contract for the period of 5 years, and now those 5 years are over. It's time to renegotiate based on what is going on in the market today. Now, that renegotiation is happening because the contract that you signed expires within 5 years, for example. And that 5-year period is called a mortgage term. And with those terms defined, we now have a good baseline to proceed into the video. So let's start with the obvious. Number 1. Where to get a mortgage from. Sounds like a simple thing, but if you don't know the length and breadth of where to source your funds from, it can really limit your search for a mortgage that works for you. So obviously everyone knows you can get a mortgage from a bank. Next, you can get a mortgage from a credit union, which is like a bank, but they aren't there to make so much money off your back. They're there to protect their members, but more on that later. Next, you can get money from a private lender, which is someone, a human being. This is someone, usually an individual like you, who has entered into the business of giving people $450,000 loans or loans of large amounts of money that people can use to buy their houses. And then they set their terms. But keep in mind, private lenders have a higher interest rate. This means that they want more money back for the favor that they're doing you. So be very careful and make sure you study the terms of your contract. Now, don't be surprised. A lot of people well, a good number of people get their mortgages from the person that is selling them their house. This is usually called a vendor take back. So think of it this way. You want to buy that $500,000 house from someone, and that someone says, hey, instead of paying me the lump sum of money all at once, pay me in little bits on an interest rate that we agree on and several other terms that we agree on over a specific period of time, so you don't have to go to the bank and deal with all that paperwork. This is called a vendor take back mortgage. So these are options that you can explore just so that you can find something that works for your situation and not get stuck in a corner waiting for just one of these people to answer. So number 2, if you've not watched the down payment video, which is episode 1, I highly suggest and I highly recommend that you watch it, because down payments and mortgages are intertwined. You cannot do one without the other. But let's get back into the video. Number 2, what do lenders want to see? So lenders want to see a good down payment. To be very specific, they want to see a minimum down payment and anything above. So just as a quick refresher, a minimum down payment is the smallest amount of money that you must have before any lender starts to take you seriously. So for your $450,000 mortgage or for your $500,000 house, you need at least 5% of that money. 5% of that money is $25,000. So that is the smallest amount of money that you need to buy a $500,000 house. Now, there are other rules, but I've discussed them in my previous video in episode 1 talking about down payments. So please go watch that video. That will help you get a standard foundation for anything else that we're going to talk about today. Lenders also want to see that you have the capacity to pay back your mortgage or pay back any loan that they give you. And normally, the first indicator that they look at to someone who is able to pay back their mortgage is their job. So they want to see that you have a steady job and steady income that you can always draw from to repay your loan. They don't want people that will default, and that's why sometimes getting a mortgage, if you're self-employed or if you're in any other type of situation apart from having a steady 9-to-5, can be kind of tricky. Now, another thing is that since lenders want to know that you're able to pay back your loan with your salary or your steady income, they also want to know that you don't have too much debt, or more precisely, they want to know that you are responsible with your money. So they will be checking your credit history and your credit score. So make sure that you have a good credit score, good credit history, just so that you save yourself the stress of having to explain yourself to a lender that might not be very interested in working with low credit scores or bad credit histories. Now, speaking of debt, the lender also wants to know that you have something called a good debt to income ratio. Just simply, it means that they want to make sure that you don't have too much debt and too little income to pay off that debt. So as a very simple explanation, say you have $100,000 worth of debt and you only have $20,000 worth of assets or income. How are you going to pay your mortgage? That's the question that the lender is going to be thinking of. How is this person that is only bringing in $20,000 and already has $100,000 worth of debt going to handle an extra $450,000 worth of debt? So you want to make sure that your debt to income ratio is good enough for any lender to have the confidence to give you more debt, because that's what a mortgage is. It is just more debt, and they want to make sure that you don't already have too much debt and they won't be in line, or you won't be able to handle all this debt if they lay more on you. Now, with that being said, number 3 is very, very important, and I'll start number 3 off with a story, and it's all about getting your pre-approval. So recently, I had a friend who wanted to buy a house, and this house was a fantastic house. It cost just the right amount because, as you know, we are currently in a buyer's market, but this friend wasn't fast enough, and I'll explain. Normally, when you want to get into the market, you must make sure that everything else that you need to put up an offer immediately is available. And one of those things, one of the most important things that you need to get together is a pre-approval. So you sit with a mortgage broker or you sit with anyone that's going to give you a loan, and they tell you how much you can afford or how much house you can afford based on your income, based on all the things that we spoke about in number 2. So they'll look at your debt, they look at your credit history, they'll look at your income, put all those parameters together, and they give you a figure. So for example, if you can afford a $450,000 mortgage, they're going to let you know. So this friend hadn't done his pre-approval, and as a realtor, I couldn't justifiably put in an offer because he might not have been able to qualify for that amount. Just protecting my customers, protecting my clients as usual. And because of that, that fantastic deal got lost, and it was very painful. It was a beautiful house and it was adequately priced, but it is what it is. I have to protect my clients. This is not about me making a buck. This is about making sure that my clients don't get into any trouble that will and can plague them for the rest of their lives. If you're getting into the market, make sure that you sit with your mortgage broker and get that pre-approval just so that you're ready to go when you see your dream house. Now that you understand the importance of getting that pre-approval, getting into a ready state to grab the house of your dreams, we need to understand that the house of your dreams has to come up to scratch. And what I mean by this is that the person that's lending you the money, the lender, wants to know certain things about your property. And think of it this way. Once again, the bank or whoever is lending you this money wants to know that that property is in good condition and is not going to collapse, or it's not going to give you so much trouble and so much stress that you're going to spend all your time, all your money, or your energy fixing it, and you won't have enough money to pay off your mortgage or take care of any of your financial responsibilities that affect that contract that you signed with your lender. So first thing that they want to know is this house that you're buying your primary residence? So the reason why they want to know, or one of the main reasons why they want to know if it's your primary residence, is to make sure that you don't already have a second property somewhere and you're trying to pay another minimum down payment. They will not be happy if they find out that that house that you're buying is not your primary residence and you're just using the system for what it's worth. Now, second in line, almost as important, is that they want to know that your property is insurable. They don't want you buying a house that an insurance company can't comfortably insure because they know that that house is in bad shape, or that house has certain things about it like bad wiring or old wiring, asbestos, and things that can harm individuals in the house, or the house itself is not structurally sound. So anything that an insurance company cannot legally insure is of interest to the person that's lending you money, because once again, it all goes back to protecting their funds and protecting their investment in your house. Make sure you get your realtor to cover your behind, because these are the types of things that can wreck financial futures. And because your lender doesn't want to buy a lemon, they will normally order a house inspection. So they'll get a house inspector to go into the house that you want to buy, make sure that everything is in tip-top shape or at least acceptable shape, give them a report. They will then decide whether the house that you're trying to buy is fantastic and is good to go, or if they can't help you, and that can actually be a make or break in terms of them giving you a mortgage to buy that house. And why this is important is because some people, without a pre-approval, which is very important, sign up offers. Now, when you sign an offer on a house, it is legally binding, and you can't go back on an offer if you don't have the appropriate conditions. And one of the conditions that you must absolutely have is the condition that you can get a mortgage. And if you don't have that condition in your contract, in your offer to the seller of the house, then these are the types of things that can happen. You will be bound to that contract, whether or not someone is willing to lend you the money that you need to do what you need to do. So be very careful with these things. Don't get stuck with a house that no one wants to lend you money to buy. Now, another thing that caught a lot of people unawares is that your lender wants to know the actual, or anything close to the actual and true appraised value of the house. So they're going to send in an appraiser. And all the appraiser is going to do is go into the house, look at the features of the house, and make sure that whatever it is that you're trying to pay for it is legit. So if you want to buy that $500,000 house and the bank or your lender sends in an appraiser and they come back and say that house only appraised for $400,000, it's going to be a problem. So always be careful when you make offers, because if you make an offer too high, then these types of things can catch you unawares. And if you've already signed that offer without a condition to protect you, if your realtor hasn't done his job to protect you, then you might be stuck trying to buy a $400,000 house for $500,000. You might even be stuck in a situation where the bank totally pulls out because they just don't believe that the house is worth it. And now that you know these things, you are now in a much better position to protect yourself from, well, unscrupulous realtors or people that just want to push you into a deal. And most importantly, in getting your deal, make sure you get number 5 right. You need to work with a mortgage broker. This is number 5, and it is probably the most important piece of information in this entire video. When you find a good mortgage broker, they will show you the ins and outs and tell you as much information as you need to make a fantastic decision. But if you don't know these things that we have talked about in this video, even a mortgage broker will be handicapped in helping you get the best mortgage for your situation. That's why we're going through this, and that's why I believe that after you've watched this video and you sit down with your mortgage broker, you're going to kill it. You're going to get the best mortgage for your situation. Now, to make sure that you're on an even keel with your mortgage broker, there are certain things that your mortgage broker will want to see, and getting these things ready beforehand will make your life a whole lot easier, will make things so seamless. And these things tie into every other thing that we've spoken about in this video. We're just going to go through them one by one just so you can catch it, get prepared, and get ready to get those keys. So we're starting with the obvious things: your means of identification, government identification, make sure it's current. You're also going to need proof of employment. So your employment letter, your pay stubs, make sure you get those things in place, just so no one questions the fact that you have a 9-to-5 or you have a business that you're running and things of that nature that they want to see in place. And keep in mind, if you're submitting pay stubs or financial statements for either your business or for your job or for your 9-to-5, your mortgage broker is going to let you know the specific amount of time that they want to see your income for. So they can ask you for 6-month statements, 30 days, 90 days, but this depends on your situation. But just know that at a certain point in time, those pieces of information are going to be required by your mortgage broker. Another very important thing is your notice of assessment. So if you've been paying your taxes, you've not been shanking the CRA and trying to play some games with them, you should be fine. Get your NOA, get it ready, and be good to go. Now, this is a very important one. They need to see proof of your down payment and also proof that you can pay for closing costs when it's time to buy that house. Now, if you've not watched the down payment video, this would be a fantastic time to go and check in with it and come back, because there are certain things that you need to know about your down payments. And if you don't know them at that stage, by the time you get to this stage, it's going to really wreck your plans. Your mortgage broker will need proof that your down payment is ready and available in the format that is acceptable to your lender, and you have a little bit extra to cover closing costs. Now, closing costs and other hidden expenses are going to be covered in a different episode of this series. Don't worry, I've got you. Now, remember we discussed the debt to income ratio. This is the part, or this is the time where they're going to ask for proof of your debts and proof of your assets and proof of your income, just so they can get a good financial picture of where you stand. So get ready to provide credit statements, debit statements that pertain to your house or any houses or any assets that you have, any car loans, things that can signify that you have debts or assets or income in certain places, so they can put that financial picture together and know if you are capable of delivering on a loan or on a $450,000 loan, for example, without any issues. Now, if you've watched to this point, I have an Easter egg for you. Don't tell anyone, but I'm going to show you how to evaluate yourself before you even get into this mortgage process. I'm going to show you what you need to do to see if you can afford a certain type of house before you even get into this process. And it's in a free website. I've linked it in the description. Don't tell anyone. If you reach the end, put it in the comments. I got to the end. Let's go to the screen. Now, this website is created or was created by the government of Canada, and it's a free mortgage qualifier tool. Now, this tool just helps you understand what you can afford. This way, you don't get into a situation where you've committed to a house and then you later find out that you can't afford the house because no one or no lender is willing to give you the money that you need or the loan that you need. We're going to be looking at all the pieces of information that we've spoken about in this video and see how they all come together in terms of getting you the mortgage that you're looking for. So let's continue with the example of the $500,000 house. Value of the property is $500,000. You have 10% available, and let's keep this interest rate. And remember your amortization period, how many years you're going to be paying this up for. Let's put it to 30 years. And if you notice, this is the maximum amount of time that most people will, or most lenders will allow. Minimum is a year, I believe, and maximum is 30 years. And payment frequency means that you're just going to be making one payment every month for as long as this mortgage is alive. And now here you can see that it's going to be a monthly payment, 12 payments per year for 30 years. And remember when we spoke about the term, so every 5 years, they're going to come back and say, hey, the Bank of Canada has increased or decreased interest rates. We need to talk about the situation on your contract since it has now expired, and we need to renegotiate and get you a different contract with a higher or lower interest rate. Now, it's very important to understand, and this is why I'm doing this Easter egg, is to let people know that when your mortgage term is up, when your mortgage contract is up for this 5-year period, if you don't like what your bank is saying about the interest rate that they're giving you, this is the perfect time to shop around. This means that you can go to another bank and say, hey, what is your interest rate? Give me something good, or give me something better than I already have. And if they do, you can port your mortgage from your current bank or from your current lender to that bank and continue to pay the balance of your mortgage at that lower interest rate. It's very important to understand. And also, even before you get a mortgage, always remember and always let your mortgage specialist know that you want to shop around, meaning that you want to look at what all the banks are offering, look at all the terms that they're offering, and then choose the terms that work for you. Maybe it's a lower interest rate, maybe it's a more flexible payment. Banks are trying to be competitive, so always make sure that you shop around. Remember, in this video, I let you know that they wanted to know your income, so let's keep it at 60,000. Let's keep everything the way they are, just to keep things simple. Heating costs of the house that you want to buy, property taxes of the house that you want to buy, as well as your credit card, car payments, and other debts. Very important to understand that they want to know, or they want to understand the financial picture of your situation so they can make a better decision for them in terms of lending you the money that you need to buy your house. So let's go ahead and click calculate. Now, this is a brilliant error and I intentionally made it happen. So as another Easter egg, if your down payment is less than 20%, you must choose an amortization period that is 25 years or less. So please watch that down payment video just so that you can know the rest of the restrictions around down payments, so you don't get to this stage down the line and you find out that you can't get what you want because of missing information. So let's go ahead and change this to 20% and calculate. Now, the brilliant thing about this tool is that they will let you know if, based on your current situation, if you are able to afford buying this house. Now, there are things called gross debt service ratios and total debt service ratios. But basically, they're just trying to look at what you are able to carry in terms of servicing your debts without having any issues in paying your mortgage. Now, if you read this, you'll find that they are giving you more advice and saying that you may still qualify for a mortgage if your GDS and TDS ratios are slightly higher. Higher is not good, lower is better. Lower means that less of your money is chasing debt and you have enough money to service more debt, which is, for example, the loan that you're trying to get. Even here, you can see that you will likely be denied for a mortgage amount of $400,000 because your GDS and your TDS are not within acceptable ranges. So if you need to know more about GDS and TDSs, you can reach out to me. We can have lengthy discussions. You can call for a live if, I don't know, if there are enough people watching this video, and we can go over these tiny little details in greater detail. So here you have a breakdown of what you're asking for. How much are you asking for? Request amount. You're asking for a $400,000 loan. And the reason why it's $400,000 is because you've indicated over here that you have 20% down, and 20% of this is $100,000 over here. So you're asking for a $400,000 loan. Now, if you've watched the down payment video, if you have anything above 20%, you do not need to pay for mortgage loan insurance. So you're free on that. And there are also catches with mortgage loan insurance. So please watch the down payment video when you can. And the total mortgage that you will need is $400,000. Now we have your GDS calculation, and you can see how many things, or the specific things that they're looking at, just to make sure that you don't have too much debt on your neck. So if you go into this contract with this gross debt service ratio, it means that you're going to be paying approximately $2,195 a month in your mortgage, and you're going to be paying about $150 in heating, property taxes, $200 a month. And by the time they look at it, basically most of your income, in fact, probably exactly 50.9% of your income is going towards servicing debt. So that means it's, in their mind, they don't think that you have enough to actually service extra debt. Now, TDS ratio calculations, pretty much the same thing. It's just that now, if you look at the difference between a GDS and TDS, all they're taking into account is just stuff that has to do with the house that you want to buy. So your heating costs of that house, your property taxes of that house. And pretty much if you are getting a condo, they're going to take half of your condo fees and add that to your GDS ratio. If it exceeds the acceptable amounts, it's not always 40%. Different lenders have different percentages that they take into account. But if it exceeds a certain threshold, then things start to look a little bleak for you. And you can start to see that if you had gone ahead and placed an offer on a house, it will be a complete disaster to come to this stage and start to find out that you don't even qualify for the amount of loan that you're looking for to buy this house. Now, coming to the TDS, they're adding on all your other debts just to get your total amount of debt servicing in one place. And once again, you can see that because they've added more debt, or more of the debts that this hypothetical individual is servicing, this percentage amount has gone up. If you've made it to the end of the video, make sure you check the link. If you're looking to buy a house, get this mortgage qualifier tool up and running, just so that you can see exactly what it is, or have a good estimate of what it is that you're trying to get into. And once again, you can always use this tool as well as these videos that I'm making to make sure that you get the best decision for your situation and protect yourself. And with that, you have a solid foundation that you need to attack this mortgage thing with all the confidence in the world. Don't worry about it. There's information everywhere. Ask me questions. I'm happy to answer. I can refer some very good mortgage specialists down the line. Talk to me. I'm your guy. Let's get you those keys. In the next video, we're going to be talking about interest rates. It's going to be fantastic because now your mind is going to be opened to whatever else it is around interest rates that can affect your ability to get the best house for your situation. My name is Ayobami Macaulay. I'm a realtor in Canada, in Ontario, Canada to be precise. Nice to meet you. Thank you for watching.